Does the world seem like it's falling apart? The firm belief that inflation is temporary has been shattered, leaving global consumers in mental collapse. As of 2026, the Consumer Price Index (CPI) in major economies is breaking past previous highs and skyrocketing fearfully. Due to currency depreciation, real wages are stagnating or shrinking, leaving those who waited in extreme panic over the widening wealth gap. The market is a ruthless microcosm of global capitalism that does not move according to our emotions or wishes. It has been painfully proven that the vague hope of prices dropping if we just wait is a dangerous illusion. Today, through this 10-part series, we condense the cruel truth based on the latest economic data and current market status. Please coldly face the painful reality of the 2026 global economy, which is uncomfortable but absolutely necessary to know. The decisive trigger for this rebound in global asset prices is the aggressive shift in monetary policy by major central banks. The harsh interest rate hikes meant to choke inflation have shifted, creating ripples across the global economy. This became a powerful buying signal, allowing waiting capital that was previously tied up to enter prime markets. Contrary to policy intentions, demand suppressed by strict regulations poured into core assets like a bursting dam. As soon as the regulatory locks preventing purchases were released, the swift shopping spree of the cash-rich began. An artificially suppressed market is like a spring that bounces back most fiercely the moment policies are eased. Ultimately, assets in the best locations are the first to recover their prices and reach the highest peaks the moment regulations are lifted. The fatal mistake of those waiting on the sidelines was ignoring the most objective real-world data: supply shortages. The fragmentation of global supply chains due to geopolitical tensions and friendshoring has resulted in a chronic supply cliff in 2026. Furthermore, with skyrocketing labor and material costs driven by resource nationalism, an era of insanely high production and construction costs has begun. Producers cannot lower prices due to raw material costs, and consumers turn away, thinking existing assets are cheaper. The soaring costs of new developments act as a sturdy floor for existing asset prices, pushing them even higher. The clear statistical truth is that demand is overflowing, but new supply is desperately lacking. Expecting price drops in a market where supply is cut off completely denies the basic principles of economics. Geopolitical risks have emerged as a primary economic driver, creating an ironic situation that pushes asset prices up. Trade barriers, sanctions, and regional conflicts cause market distortions, trapping capital and limiting global trade. Pushed to the edge, investors are forced into the buying market to secure tangible assets amid extreme scarcity. Added to this is a listing freeze where assets, once sold, do not return to the market due to punitive taxes and regulations. While buyers surge due to inflation fears and deregulation, prime listings vanish, allowing asking prices to dictate the market. An abnormal structure is completed where just a few new high-price transactions cause the entire market value to skyrocket. Regulations and supply shortages have collaborated to lay the most perfect and cruel foundation for price explosions. The most painful characteristic of this bull market is the strict and extreme polarization, where not everything rises equally. While struggling secondary markets drown in stagnation, core global hubs and prime tech assets pierce through previous highs and soar. Feeling the burden of global uncertainty, wealthy individuals dispose of peripheral assets and consolidate their capital into one prime asset in core areas. Even if overall growth slows, the demand from capital trying to enter irreplaceable core infrastructure is exploding. The trap of averages, believing if the periphery falls, the core will fall too, has handed the greatest despair to the uninvested. Now, global capital has perfectly entered a strict class society where only what goes up continues to rise endlessly. The price of underestimating the value of irreplaceable scarcity is far too harsh. The one-dimensional economic common sense that high interest rates unconditionally crash asset prices blinded the public. As soon as the rate hike cycle paused, market liquidity rushed into real assets first to defend against inflation. Falling interest rates mean the value of the cash sitting in your bank account melts away even faster. The capitalist system inherently expands currency, making long-term cash depreciation and real asset appreciation inevitable. Cash safely stored in a bank is robbed of its purchasing power every single day by the invisible thief called inflation. The naive formula that interest rates and asset prices are exactly inversely proportional fails entirely before a massive wave of inflation. Holding cash, the most dangerous asset, without the defensive shield of real assets results in the tragedy of sudden poverty. For those who only waited on the sidelines for a miracle or perfect conditions, all that remains are expensive entry points and despair. The passive mindset that made them wait for government benefits or perfect macro conditions while missing independent buying timing was a fatal anesthetic. People who tried to perfectly time the market, swearing to buy at the absolute bottom, ultimately missed all entry opportunities when transaction volume was dead. The bottom is the realm of the gods, visible only in hindsight. People realize too late that maximum public fear was the only optimal time. The arrogance of trying to catch perfect timing causes you to buy at the absolute peak or age forever without assets. If you have the manageable loans and cash flow prepared, the timing to acquire core assets is always right now. You must admit the painful mistake of viewing assets solely through the lens of short-term trading while ignoring their defensive value. From the past to the present, every policy attempting to artificially suppress prices has ultimately returned as a boomerang, causing massive price spikes. Punitive taxes locked up supply, and deregulation became the kindling that instantly exploded suppressed waiting demand. Governments are proving themselves that they cannot permanently control supply and demand, the absolute laws of the market, with artificial regulations. The saying "do not fight government policy" does not mean the government defeats the market, but rather to ride the gaps and waves of those policies. Blindly trusting verbal interventions or price suppression tactics while delaying your vital asset defense plan is extremely dangerous. We must never forget the objective fact that the majestic flow of the market moves much stronger and sharper than any government dam. The assets that protect your family cannot be secured by state policies, but only by your own cold judgment and decisive action. There is no time to merely despair. If entering top-tier core assets is difficult now, you must re-evaluate the best possible locations suited for your capital. Instead of Class A areas where asking prices have already flown away, target Class B or C regions with strong fundamentals and upcoming infrastructure improvements. Enduring the inconvenience of older, value-add assets with redevelopment potential is also a solid niche strategy to grow wealth. If you already hold a peripheral asset, you must execute an upgrade to core areas, taking advantage of lowered entry barriers during market shifts. Strategically utilize tax exemptions and market gaps to upgrade your asset portfolio step by step without unnecessary capital leakage. Abandon the vanity of finding the perfect asset right away, and deeply value the defensive power of a single solid asset that anchors you to the market. Only those who sharply penetrate the price gaps that open up when the market fluctuates can climb the ladder of the capitalist class. Through this 10-part series, we condensed the cold data and facts of the 2026 global economic market that shattered the mentalities of the uninvested. The supply cliff, the butterfly effect of policy shifts, and the decline of currency value all prove the truth that nominal asset prices trend upward. Resentful prayers wishing for prices to crash will not increase your bank balance by a single cent. Acquiring solid assets is not simple speculation, but the most perfect concrete shield to protect your capital and family's well-being from inflation. Now, turn off the emotional switch and walk right into the center of the market with cold rationality and execution based strictly on numbers. Only those who have overcome their darkest fears can grasp the heavy and sweet spoils of capitalism known as a title deed. Whether you will be swept away by the massive wave of the global economy, or grab a surfboard and enjoy riding it, is entirely up to your choice. The full reality of this massive shift, check it out right now on our channel Masterclass.